Welcome to the Deep Dive. This is where we take, well, a whole stack of important articles, research, all that stuff, and boil it down to what you really need to know. Our whole mission here is basically to give you a shortcut, help you get well-informed without drowning in information, cut through the noise, you know. So today we're diving into four really big stories. They seem separate, but they're actually pretty connected. Big economic and geopolitical shifts shaping things right now. We're talking about a global climate fight, a bit of a default scare over in Europe, some new alliances maybe challenging the U.S. dollar, and that ever-growing tech battle over computer chips. And look, this isn't just stuff happening far away. These forces, they can hit your electricity bill, the price of your next phone, maybe even, the stability of a whole global financial system. Let's start connecting some dots.
Yeah, and it's that interconnectedness that's really fascinating, isn't it? These global currents, they can shift so fast. Often it's policy decisions, big geopolitical moves by major powers driving it all. We'll try to connect those dots for you, show you not just what's going on, but crucially, why it matters, what it could actually mean for your day-to-day.
Okay, so let's dive right into the first big one then, renewable energy. We've been hearing quite a bit from the current Trump administration about its take on green energy, both here in the U.S. and, well, abroad too. Seems like a definite pushback against certain international climate rules and maybe even slowing things down here at home.
Yeah, that's right.
Can you maybe unpack that a bit, especially the international part? What warnings are being sent out?
Well, what's interesting here is the nuance. They're not just saying don't use renewables. It's more specific. The administration's targeted countries that support particular international climate policies. Specifically, this thing from the International Maritime Organization, the IMO, they have a net zero framework. It's about putting a global price on carbon for the shipping industry. And the U.S. has warned countries pretty publicly that if they back this framework, they could face things like tariffs on their goods or even travel restrictions, visa limits, potentially.
Wow, okay. Tariffs and travel restrictions.
Exactly. So think of it like this, right? You've got this global group, the IMO, trying to agree on a fee for ships based on their carbon emissions. The U.S. is basically stepping in and saying, hey, if you support that fee, which we think will hurt American shipping and cargo owners, well, we might hit you with taxes or make it harder for your citizens to visit the U.S. It's pretty clearly seen as a move to block this global agreement on cleaning up shipping. And there's a big vote on it coming up in October.
So actual letters going out, warnings of corresponding measures if these rules raise costs for U.S. interests. I saw Riviera Maritime Media even reported worries that this could, shake the IMO's authority. But like you said, it's not just international, right? What about here in the U.S.? What's the parallel move?
Right, that's a key point. Consistency. Domestically, you see a similar kind of anti-renewable stance playing out. We're seeing moves to roll back subsidies for wind and solar power, limits on new projects going up on federal lands and in federal waters, too. There have even been calls to halt some big offshore wind projects that are already underway. It's like, well, deliberately putting obstacles in the path of cleaner energy development right here.
Okay, so these aren't just abstract policy debates. Let's talk real-world impact. What does this actually mean for, projects, investments, prices?
Yeah, the consequences are pretty tangible if we connect the dots. First, for renewable projects and investment right here in the U.S., we've seen a definite spike in cancellations, delays for big wind and solar projects. Why? Well, more risk around permits, subsidies disappearing, financing is getting tougher, and, global investors are maybe thinking twice about putting their money into U.S. renewables right now. It looks like that sector is shrinking a bit investment-wise.
Okay, so less investment in green energy here. What about fossil fuels then and our electricity bills?
Well, that's the irony, isn't it? Some experts are pointing out that these policies, the ones pushing against renewables and also tariffs on equipment, they're actually making grid stuff more expensive. So paradoxically, it could end up increasing U.S. electricity rates. And think about the demand side. AI data centers are guzzling power. If you suppress renewables while demand is soaring, well, power just gets more expensive and maybe harder to get online quickly.
Okay. And what about shipping, going back to that IMO thing?
Right. For shipping and logistics, those U.S. warnings about the carbon price, they could make shipping companies hesitate on investing in new, cleaner ships or routes. That uncertainty, plus potentially passing on carbon costs if they do come in eventually, it could mean higher prices for traded goods, the stuff you buy that comes on ships, and maybe more volatility in freight rates.
And lastly, the supply chain for things like solar panels.
Exactly. For solar and battery supply chains, countries like India or others in Southeast Asia that make solar panels and parts for the U.S. market, they're facing higher tariff risks. There was talk of maybe a 50% tariff on Indian solar modules. That makes them nervous, right? So they start adjusting inventories, maybe cutting production. It just ripples through the whole supply chain.
So if we boil it all down, what does this mean for us? It sounds like trying to maybe save costs for some industries now could actually end up costing us more later, like on electricity bills,
Yeah.
and just adds a lot of uncertainty globally.
That's a pretty good summary. It's that classic trade-off, isn't it? Short-term actions having maybe unforeseen longer-term consequences for consumers and the wider economy.
Okay, let's pivot now. Across the Atlantic, over to Europe. We saw some pretty dramatic headlines recently about France maybe defaulting on its debt. That sounds huge for a major economy like France.
Mm-hmm.
What was really going on there?
Yeah, that definitely got people talking. The core issue was political uncertainty in France. There's this upcoming no confidence vote against the government set for September 8th. That uncertainty led to a really quick widening of French government bond spreads. And yeah, some reports did use that pretty alarming phrase, default risk.
Okay, hold on. For folks who don't follow bond markets super closely, can you just quickly explain what a bond spread is and why we should care if it widens?
Sure, good question. Think of it really simply, like this. When you lend money, say, to a government by buying its bond, you expect interest back, right? Now, if you lend to someone seen as super reliable, like Germany, you accept a lower interest rate. Very safe bet. If you lend to someone seen as maybe a little bit riskier, and that was the perception of France in this moment, you demand a bit more interest to compensate for that perceived extra risk. So the spread is just that extra interest France has to pay compared to Germany. And recently, yeah, the 10-year French bond yield went up to about 3.5%. And that gap, that risk premium over German bonds, we call it the OAT bund, spread it widened out to around 80 basis points.
80 basis points.
Which is getting close to levels we saw back in 2024 during some other political uncertainty. So it's a sign of market nervousness.
And the stock market. Did it follow suit?
Oh, yeah, absolutely mirrored that concern. French bank stocks especially took a pretty sharp hit. You could see both the bond market and the stock market were just really sensitive to the political news flow, particularly the idea that if this no confidence vote failed, it might trigger early elections.
Yep.
And that just means more uncertainty, delays on budget plans.
Right, more uncertainty. But why jump to the word default? I mean, France isn't Greece in 2010, right? It seems like a strong word.
It is a strong word. And the main concern wasn't really about France not being able to pay its bills tomorrow. It was more about a perceived loss of fiscal credibility. See, the government's trying to push through a tight budget, get the deficit down, but their political footing looks shaky. So doubts creep in. Can they actually implement these spending cuts? Will the budget stick? France's deficit for 2025 is projected to be above the EU's 3% limit, and that's kind of a red flag for markets. Now, you mentioned CDS credit default swaps. Basically, insurance against default. French 5-year CDS did tick up into the high 30s basis points, but, and this is important, that's nowhere near the levels you'd see for a country genuinely considered high risk, Not panic stations, but definitely elevated concern.
Okay, so putting it all together, how serious is this risk really? Is France actually going to default? What's the balanced view?
Yeah, the balanced view is crucial here. The basic scenario is that a sovereign default for France is highly, highly unlikely. I mean, France is a huge core Eurozone economy. The European Central Bank, the ECB, has tools ready to step in if bond markets get too chaotic. Things like the TPI, the Transmission Protection Instrument, or OMT, these are designed precisely to stop unwarranted panic selling in bond markets. And the big rating agencies like Fitch, they've kept France's rating at AA or AA3. Now, they've put a negative outlook on it, which signals we're watching the fiscal situation closely, but it's not an imminent crisis warning. Even the French finance minister basically said, look, funding isn't an issue, don't expect a financial crisis.
Okay, so not an imminent crisis, but definitely market jitters reflecting political risk. What are the experts watching now? What are the key things to keep an eye on?
There are a few key checkpoints coming up. First, obviously, the outcome of that September 8th no confidence vote. And what happens next with the government, whether early elections get called, that's number one. Second, keep an eye on that OAT bund spread. Does it widen further, say, into the 80 to 100 basis point range? That would signal deeper worry. Third, watch those 5-year CDS levels. If they started climbing towards, say, 50 or 70 basis points, that would be more concerning. And finally, the rating agencies will be doing reviews again in the fall. Their assessments will be important signals.
So what this means for you listening is, well, those scary French default headlines. Probably more about political drama spilling into the bond market than an actual financial collapse looming. But it's definitely a stark reminder, isn't it? How fast politics can shake up financial markets, even in big, established economies. Shows how linked politics and finance really are.
Absolutely, a real barometer of sentiment and how interconnected everything is within the Eurozone.
Okay, let's shift gears again. Let's look east, towards Asia. There was the Shanghai Cooperation Organization, the SCO, summit recently in Tianjin back in August. This group includes countries like China, Russia, India, Iran. It seems like it's becoming a bigger deal. What were the main takeaways, especially thinking about energy and resources?
Yeah, the SEO is definitely worth watching. And what's really striking here is the resource clout they have collectively. Just think about these numbers. SEO members together hold something like 25% of the world's oil reserves, and maybe 50% half of the world's natural gas reserves.
Oh, okay.
Yeah.
Huge.
It's massive. So when they talk about energy cooperation, it's not just talk. It carries serious weight.
So what kind of cooperation did they discuss? What were the specifics?
Well, a big one was reviving the Power of Siberia 2 gas pipeline project. That's between Russia and China. So more Russian gas flowing eastward. Plus, you've now got major oil players like Saudi Arabia and Iran involved in the SCO discussions. And that really strengthens the potential for more oil deals to be done using the Chinese yuan, the renminbi, instead of US dollar.
Right, the de-dollarization theme again. Moving away from the dollar for trade, especially in energy, that's potentially a really big shift, isn't it?
It absolutely is. If more major oil trades start happening in yuan, it could speed up this global trend of diversifying away from the dollar for energy payments. It won't happen overnight. The dollar's still dominant, but it chips away at that dominance. And over time, yeah, that could lead to some real structural changes in currency markets.
Okay, so oil and gas, big focus. What about other stuff? Critical minerals, things we need for tech?
Good point. That was also on the agenda. This group, the SCO, also holds about half of the world's uranium reserves, vital for nuclear power defense.
Half. Wow.
Yeah. And China reportedly offered India assurances about supply chains for things like rare earths, lithium, cobalt, the stuff that's absolutely critical for batteries, electronics, green tech. Market watchers kind of see this as China using the SCO to build a sort of resource block, maybe trying to counter past criticism about, weaponizing rare earth supplies. It's about securing access within this group.
So forming a resource block.
Yeah.
How does all this potentially play out in global financial markets? What's the impact on currencies, commodities, stocks?
Right. Connecting it back to markets. There are a few angles. For currencies, like we said, the push to use yuan, rubles, rupees for trade within the bloc reduces reliance on the dollar. Short term, that could put a bit of downward pressure on the dollar, and it certainly boosts the idea that the yuan could become more international. For commodity and energy prices, if this SCO bloc gets stronger, it gives sanctioned countries like Russia and Iran more places to sell their resources, right, within the bloc. Now, that might create more uncertainty for, say, Europe's energy security. But interestingly, it could potentially lead to lower oil and gas prices in Asia over the medium to long term, just because there's more supplies circulating within that regional bloc.
Lower prices in Asia, interesting. And stocks and bonds.
Yeah, in stock and bond markets, the summit seemed to give a little boost to emerging markets in China, India, Central Asia. The thinking being maybe less geopolitical risk within the bloc, more infrastructure spending. But on the flip side, some Western investors looked at the SEO getting stronger and saw it as, maybe a sign of a new Cold War, more fragmentation of global supply chains. And that might lead them to demand higher risk premiums for investing in certain areas.
So really, the SCO summit feels like another signal of this move towards a more, multipolar world, where resources, trade, it's all viewed through this geopolitical lens now. Power isn't just in one or two places.
Exactly. It points towards a future where economic influence might be more distributed. Now, look, the SCO has its own internal disagreements, right? That might limit how much impact it has immediately. But the long-term potential is there. Experts think it could fundamentally reshape global asset markets down the road, affecting everything from energy prices to where you might find the next big investment opportunities.
Okay, fascinating stuff. For our final deep dive today, let's circle back to the U.S. and China. That ongoing tech competition, especially around semiconductors, those vital chips. We saw reports that the U.S. Commerce Department pulled some waivers for Korean chip companies operating in China. What's the latest there?
Yeah, this is a really significant move in what people are calling the chip war. The Commerce Department basically withdrew these special permissions, these waivers. They had allowed big Korean companies, specifically SK Hynix and Samsung, to keep bringing advanced chip-making equipment into their factories in China. The Biden administration granted those waivers back in 2023, but the current Trump administration has now revoked them.
Okay, why now? What's the goal behind pulling those waivers?
Well, the official reason given is basically to ensure foreign chip companies don't get advantages that U.S. companies don't have, especially when it comes to upgrading their tech or expanding production inside China. It fits into the broader U.S. strategy, right?
Mhm.
Trying to slow down China's progress in making really high-end chips, the kind you need for AI, supercomputing, that sort of thing.
Right.
Now, they can still maintain the equipment they already have in China, but any major upgrades, any expansion of capacity using advanced U.S. tech, that's now explicitly blocked. It's really about capping their ability to produce more advanced chips in China.
Seems like a pretty direct hit. Did this catch South Korea completely by surprise?
It seems the U.S. did give the Korean government a heads up. It's very likely this was a major discussion point when the Korean president was in Washington recently, talking trade, export controls, tariffs with President Trump. So while it's definitely a big deal for Samsung and SK Hynix, it probably wasn't a bolt from the blue for the government in Seoul.
Okay, so the restrictions are tightening. How are Chinese companies reacting? Are they just, taking this hit? Or are we seeing something else?
Actually, quite the opposite. And this raises that question again about unintended consequences, maybe. What we're seeing is Beijing really doubling down on achieving self-reliance, self-sufficiency, especially in these critical areas like AI and chips. They aren't just waiting around, they're actively trying to build up their own capabilities.
Okay, can you give some examples? Like, what does that look like on the ground?
Sure. Take Huawei, for example. They're pushing hard, expanding their AI computing infrastructure. They're developing their own AI chips designed to compete with the likes of NVIDIA. Now, maybe their chips aren't quite as powerful as NVIDIA's absolute top-end stuff yet, but reports suggest they're proving very effective for running AI models. That's a big step toward having a viable domestic alternative.
Right, an alternative. Anyway.
Yeah, look at Alibaba. Their cloud business is booming because of AI, right? But they're also investing heavily in designing their own AI chips. It's kind of like what Amazon does, right? Design custom chips to be less dependent on outside suppliers like NVIDIA, and maybe eventually cut down costs on those really expensive AI chips. Alibaba's saying they see huge demand for AI infrastructure, not just for chatbots, but from car makers, media companies. Everyone wants to build and scale AI models, so having their own chips makes sense.
So what's the big picture takeaway here for us? It sounds like the U.S. policy might not be completely stopping China's tech goals, but maybe pushing them to innovate faster internally, develop their own stuff.
That seems to be a key part of the dynamic, yes. Some experts actually argue that, far from crippling Chinese tech internationally, these U.S. restrictions are effectively accelerating China's domestic tech development, strengthening their internal supply chains. Some even suggest these restrictions might eventually have to be revisited or maybe even rolled back, because at the end of the day, they can also hurt U.S. companies who lose access to the Chinese market or face disruptions in their own global supply chains. It's a really complex strategic game being played out.
Wow. Okay, that really was a deep dive. We covered a lot of ground today, from global climate policies and the economic effects to that political drama in France shaking up bond markets, then the SCO summit and the challenge to the dollar, and finally this intensifying U.S.-China tech war over chips. Ooh.
We certainly did. And what's really striking, as we said at the start, is how tangled up all these things are, aren't they? A decision made in Washington about renewables can affect investments worldwide. Political stability, or lack thereof, in France sends ripples through the whole Eurozone. A summit in Tianjin could start reshaping global energy trade and currencies. It really shows how local actions can have global consequences, and the other way around, too.
For you listening, trying to make sense of your world, what does this all mean? I guess it's just a reminder that the global economy is this incredibly complex web. And understanding these deeper currents, these big shifts we talked about, it helps you understand everything from, your utility bill to the price of stuff you buy, maybe even figure out where the next big opportunity or risks might be.
Absolutely. And maybe a final thought to leave you with. We're in this era where major powers seem to be increasingly focused on their own paths, right? Energy independence, fiscal control, tech, self-reliance. So the question to maybe mull over is, How long can these global economic systems, which were built on decades of everyone being interconnected and interdependent, how long can they stay stable when key players start pulling in different directions? What new alliances or maybe new divisions will come out of all this? Definitely keep watching those headlines because I think the ripple effects are really just getting started.
Couldn't agree more. Well, thanks for joining us on this deep dive. Until next time, stay curious and keep learning.